In this video, I'll give you a simple introduction to bond investing, and we're starting right now. Hey guys, Elliot here. I bet as an investor you thought about bonds but then wrote them off as too complicated or too boring. Stocks, after all, is where all the fun is, and bonds are for cigar-chomping older investors sitting in their retirement homes, right? Well, not entirely wrong, but not entirely correct either. Bonds are a major investment class, and you need to know about them as they're probably already a part of your retirement fund. Let's jump into the topic for a few minutes, and by the end, you'll be glad you did and perhaps even become an active bond investor. So first of all, let's get a few definitions out of the way, starting with what exactly is a bond. Bonds are debt obligation securities and stand in contrast to stocks, which are equity securities. A bond is simply an IOU from the issuer or the borrower to the bondholder or the creditor that says that the issuer will pay back the value of the bond plus interest. Fundamentally, it's no different than you taking a loan out from the bank and having to pay back the loan plus interest. So bonds are first and foremost an instrument to borrow money. Bonds are also referred to as fixed income securities because the interest income they generate for the bondholder is usually fixed and predictable. Bonds are purchased and held by both private and institutional investors for the same reason banks make loans, to make money off the interest, and are considered an essential part of a balanced and diversified portfolio. In today's fairly low interest rate environment, they're looked at as a not terribly lucrative but very safe investment as compared to stocks. So who issues bonds? Well, they can be issued by the federal and local governments to fund the regular operations or infrastructure projects, and by corporations to raise money for expansion or acquisition. So again, bonds are basically a funding source for large entities. Regular people go to a bank or to a relative to borrow money. Governments and corporations issue bonds. There are a few more definitions that you have to know in order to speak the language of bonds. The first set of terms are principal, face value, and par value. These terms are equivalent and they refer to the amount of value that is stated on the bond and usually what you initially purchased it for. In other words, this is the amount of money the bondholder loaned to the bond issuer. Bond principal amounts can vary widely. The smallest amount one can invest in is $25 for a U.S. savings bond, and it goes up from there to $100,000, $5,000, all the way up to $10,000 and even higher depending on the type of bond. The next term is maturity. This refers to the date when the purchased bond will be repaid in full. It can be thought of as the length of the bond in the same way as we refer to the length of a road trip. Maturities can vary widely from as little as a few weeks all the way to 30 years or longer. Next terms are coupon rate and interest rate. These terms are equivalent. This is how bond issuers pay for the privilege of borrowing money and how bondholders make their money. The interest or coupon is expressed as a percentage of face value. So if the value of the bond is $1,000 and you're promised 5% interest, then the amount you will receive is $50 annually for each such bond that you hold. Bonds usually generate interest payments every 6 months, but every month, quarter, or annual payments also exist. Interest rates are usually fixed, but can sometimes be adjustable as well. The next term is yield, and this is the true payout of a bond. This is one of the more confusing aspects of bonds, and it has to do with the price fluctuations. In essence, yield and interest rate are equivalent if the price is exactly the face value. So for a $1,000 bond paying a 5% interest rate, the yield is also 5%. However, if the price of the bond drops to $800 or rises to $1,200, the interest rate, which is fixed at 5%, gives a different yield with this new price. Now, there are two types of yield calculations: simple yield and the most accurate yield to maturity, or YTM, but this calculation can get somewhat complex, and we aren't going to go over it in an introductory video. The next term is issuer, and this refers to who issues the bond. As mentioned earlier, there are, generally speaking, two major issuers of bonds: governments, both federal and local, and corporations, and I'll discuss both in more detail in a little bit. And for the final definition, we have ratings. This grading of bonds refers mostly to corporate bonds, as corporations can't tax anyone to back up their bond issuances and must rely on good credit ratings to assure investors that the bonds will be paid back, and I'll discuss corporate bonds in more details in a little bit as well. Okay, so now you should have an idea of all these basic definitions of bonds. Let's now discuss government bonds in more detail and then corporate bonds. First up are federal government bonds. There are several types and they are all collectively called Treasuries. The three types are Treasury bills or T-bills, and they have a maturity of less than a year. Then there are Treasury notes or T-notes, and they have a maturity of up to 10 years. And finally, we have Treasury bonds with a maturity of greater than 10 years all the way up to 30. There are also a number of other related Treasury securities such as savings bonds, TIPS, and FRNs, but we won't really get a chance to discuss them in this introductory video. So how do you invest in and purchase T-bills, T-notes, and bonds? The best way is directly from the federal government at the website treasurydirect.gov. Here's a screenshot of the website, and as you can see, there are a number of options from the drop-down menus for individual investors to use. Also, if you're curious, these are the current yields on bonds. So the other government bonds I want to mention are sold on a city or municipal level and are called municipals or munis. Munis are attractive to many investors due to most of them being tax exempt, and they fall into two broad categories: revenue bonds, which fund revenue generating projects such as toll bridges, and general obligation bonds, which fund non-revenue generating projects that are for the public good. As an investor, you can buy either one. How do you invest in and purchase munis? Well, unlike treasuries, you can get these from bond dealers, banks, brokerage firms, and sometimes even directly from your municipality itself. Okay, so that is the basics on government bonds. Let's now talk about corporate bonds. I've already mentioned why corporations sell bonds. It's to raise money. They can also do this with sales of stock, but the advantage with bonds is that the company doesn't have to give away equity or a piece of itself when it issues bonds. A company can also go to a bank to borrow money, but that is more expensive than selling bonds. There are two basic types of corporate bonds: short-term ones, also called commercial paper, and regular long-term bonds, just called corporate bonds, and we'll mostly just talk about them. Now, the first thing you need to know about corporate bonds is that they are rated for quality, similar to individuals being rated with a credit score. Some well-known rating agencies include S&P, Moody's, and Fitch, and they rate corporate bonds from AAA to AA to A, then B, all the way down to C and D, which is junk status. The ratings, of course, have to do with the ability of the company to not default on paying back the bonds, and you generally want to stick to your investment grade AAA or AA bonds, as they are the safest and are issued by the strongest companies. Investing in corporate bonds is very easy. You can buy them from bond dealers, brokers, or banks. Okay, so those are the basics on the two main types of bonds you can invest in: government and corporate. Now, it's worth mentioning that for investing purposes, you don't necessarily need to purchase individual bonds. Instead, you can invest in bond mutual funds or ETFs. There are quite a few out there, and they tend to specialize in only government or only corporate, and this is a great way to get into bond investing with relatively low risk and not having to buy bonds one by one. Some well-known and very large bond ETFs include Vanguard's Total Bond Market ETF, ticker symbol BND, iShares Core US Aggregate Bond ETF, ticker symbol AGG, and you can also invest in overseas bonds with something like Vanguard's Total International Bond Fund, ticker symbol BNDX. There's a lot more to bonds, and they can get relatively complex. I didn't talk about bond yields and pricing in any real detail, or what bond duration, convexity, and yield curves are, as this is just an introduction. As always, if you enjoy this content, please do like and subscribe, and I will see you in the next video.